All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm joined here, as always, with Renji Matthew. And on today's episode, we're going to be talking about the proposed 25% unrealized capital gains tax bill that President-elect Kamala Harris has just released and is talking about potentially imposing going into 2025. And we're going to talk about what it is, how it works, who it's going to affect, and some potential problems with it in the long term. So, Renji, I think first and foremost, we should probably define what an unrealized capital gains tax is and what the concept is. And simply enough, it's taxing gains that, what's the best way to put it? So it's having gains in real estate or stocks that you haven't yet sold. And when you sell your stocks is typically when you realize these gains. If you haven't sold the stocks, but they're still sitting inside of your brokerage account, for example, that's where you have these unrealized gains. And typically, you're not taxed on these gains until you go to actually sell it and you have your profit, right? But these unrealized gains would have the wealthiest of Americans over a $100 million net worth be taxed on the unrealized gains of their assets each and every year at 25%, right? So this is kind of even crazy to think about, that people would have to pay tax on their investments and their assets from gains that they've not even actually realized because they haven't sold their investments yet. Right. So, Renji, anything that you want to add to that, or any insight that you have for us on what your thoughts are initially with this proposal?
Yeah, I mean, I think they're trying to do this where, it's taxing the rich more. But the problem, I think we've talked about this before on a previous podcast. The problem is the rich will figure out a way to get away from it, right? If anything, we're seeing billionaires starting to leave the country. And, the problem with that is you're taking out the wealth from the country, so for the everyday people, because it'll start dwindling down, like it'll start with the wealthy and then slowly start going into middle America, which is what always happens when tax burdens are put on the wealthy. It somehow dwindles down to the middle class. And the problem with that is the middle class, they might have a house that they've been putting money into for 10 years. And it's worth $200,000 more now than it was back when they first bought it. And that $200,000 they'll have to pay tax on, even though they don't have the money or their income hasn't gone up. And that's going to put a tax lien on a lot of people where they won't be able to afford that tax bill. And with that, what investors also do, being in the real estate space, I see a lot of investors buying properties through tax liens. And I feel like that's what's going to happen is a lot of people are going to lose their properties or, have to go into renting because they won't be able to afford the tax burden that this is going to put on them because their income's not going up, right? That part's not changing unless they do something to increase their income. They're going to have to pay tax on that. And this is just real estate we're talking about. There's also 401ks, this is going to force people to invest into things that are short-term instead of long-term.
Yeah, everything you said is, and we kind of talked a little bit pre-show about the different pros and cons to this. And one of the things you touched on, and who is this affecting? Who is it supposed to affect, at least only initially? It's people that have a net worth of over $100 million. Now, to majority of the people watching this is probably not them, right? But the one potential problem with that is, sure, it might start off at a $100 million net worth, but then it starts to lower, and it's people with net worths of over $10 million or $1 million, or maybe a net worth of over $100,000. And it sounds crazy to say that, and of course they're not talking about it right now, but the reason people think that this could happen in the future is because at once, we never had income taxes. Income taxes came out in the early 1900s and was initially only for the wealthy. Now, what do we find today? Everybody pays taxes on their income as long as they're making over, I think it's $20,000 or $22,000, somewhere in that range. So yes, it started out as an income tax only on the wealthy, has later become a tax on everybody. And it could be the same thing here. And that's the one potential problem that a lot of people see with this. Now, not only that, I just think it's kind of morally wrong for anybody to have to pay taxes on gains that they actually have not realized. And to put it simply, let's just use small numbers to talk about the impact and what it actually means. But let's say that you bought like Apple stock, and you bought $100,000 of Apple stock a year ago, and today your Apple stock is worth $200,000. In this year, you would have to pay 25% the 25% tax on your unrealized gains in your account. So you started off with 100,000, you've went up $100,000. That's your gain, but you haven't sold it. You haven't realized it yet. Your tax for this year would be $25,000 or 25% of your $100,000 gain that you would have to pay even though you haven't sold any of those assets. Now, one step further, what if next year the market goes down, Apple stock just completely tanks, and now it's worth less than what you paid into it? It's only worth 92,000, let's say, but you paid into it 100,000. You pay taxes on gains you never even realized, and now your account value is lower than what you actually started with. Like, that could be a real case scenario for people having to pay taxes on gains that they never even realized, and then later on, that investment, those stocks, that real estate is now worth less than what you actually paid into it, and all this time you were paying taxes on gains that you never even saw. So that's another potential downside and problem as well. And now,
Well, and
here's the
something
thing.
to add on to that too.
Go ahead. Yeah.
When they have that, this will cause them to sell that, right, to pay it down. But now when they sell that, that's going to be considered income tax too. So now your income bracket's higher. So you're getting taxed on all sides.
Absolutely. And we've talked about before, how the wealthy shield themselves from different taxes and can protect themselves and almost make it look like on paper that they don't have, any money to their name. And so while we looked through some of the proposals and we're trying to find it, it's not necessarily in black or white, at least just yet. But one of the things Renji and I were thinking or talking about was how the wealthy could potentially set up trusts to actually shield themselves potentially from these unrealized capital gains. If you guys don't know what trusts are, simply it's an entity that can own or control an asset other than you to shield you, potentially from creditors, from extra taxes, and extra liabilities. So the wealthy could actually get really creative and put their different assets into different trusts that have no connection back to themselves in the first place, which could shield them from these taxes and or, never have them actually paying the tax, which that defeats the whole purpose. And then once again would expose everybody else to this new tax law, potentially, lowering its net worth requirements and becoming something that people with a net worth of 10 million or 1 million may have to contribute to. So Renji, with that, I think we've covered, what it is, how it works, who it affects, the potential downfalls. And I think with this episode, we don't have to go too long because there's not too much information that's out. It hasn't gone into effect just yet, but it's something that's come up and that obviously, we should talk about and address so people know and have a better understanding of it. But with that, anything else that you want to wrap us up with or any other thoughts that you have?
Yeah, the only other thing I could think of was, because we talk about starting side hustles or, starting businesses. If you're someone that has a great idea and you want to start a business around that and you're looking for funding, this might cause you to not get funding too, because that is also, for the investor that will be investing with you, is, long-term investing, because they're expecting to get a return from your business long-term. They might not invest now because they're worried about the unrealized gains, right? So unless you're doing really good, giving them returns, that would negate that tax bill. But if not, this might be a problem for a lot of small business owners. So that's something else to think about too.
Absolutely. And one comment that we had on our TikTok lives, someone said you shouldn't be worried about these proposals, should be focused on how the wealthy are responding and do like them. And absolutely. Exactly. And that leads us to a perfect conclusion of that's what we talk about right here on our podcasts. Do what the wealthy do. And with that, thank you guys for tuning in and thank you guys for watching. If you got to the end of this video and you have, thoughts or questions, leave them in the chat below. We do read the comments. Some of these podcasts have actually stemmed off of questions that you guys have left us. And as always, be sure to like the video, and subscribe to the podcast. And we'll see you guys on the next episode. Take care.